We're going to look at financial markets in this unit. We're going to look at how businesses raise money. And the way they make money is by us buying their investments. So we're going to do two standards here: how firms raise capital or money to either start a business or grow their business. And those are the opportunities that individuals take to make investments in different types of businesses. So once again, investing, we buy stocks and bonds. There are other types of investments, but I'm not going to cover those. These are the ones that are the most popular ones and the ones that hopefully you are familiar with. So we invest in stocks and bonds, but this is how a business raises capital. They issue stocks and bonds. So we buy them, they take the money, they grow their business, and hopefully they do a good job so we can make some money off of these investments. A little bit of vocabulary. I'm not going to go into great detail right here on this screen, but I definitely want you to know that these are the terms that you have to know, and that I'm going to give you a couple reading assignments that go into greater detail on these. So a stock exchange is kind of like a market. If I want hardware, I go to a hardware store. If I want groceries, I go to a grocery store. If I want clothes, I go to a clothing store. If I want to buy stocks, I go to a stock exchange. And if you are a business, you issue and you sell your stocks through one of these exchanges. I can't buy Microsoft at all three of these. Microsoft is sold on the NASDAQ. If I want Coca-Cola, Coca-Cola is sold through the New York Stock Exchange. So exchanges are just where a stockbroker is going to go to buy a stock. And if your stock is sold in the New York Stock Exchange, that's the only place that you can get it. We'll go into that greater detail there. Dividends, like I said, I don't want to go into detail now. You're going to have some reading assignments and things like that over this. Diversify, that's what this picture here is. You definitely don't want to put all your money into one stock. If the stock crashes, your money's gone. So you want to put some money in savings accounts, some money in bonds, some money in stocks, and then even amongst the stocks, you want to put it in different stocks. Liquidity, we'll go over that here in a minute. Blue chip stocks, when we look at the Dow, that will come into play. Capital gains and capital losses. This is just when you when you sell a stock. Did you sell it for more than what you bought it for, or did you sell it for less than what you bought it for? If you made money off it, it's a capital gain. If you lost money when you sold it, it's a capital loss. Stockbroker, that's who you call. They're the ones who actually can do the shopping on the exchanges. You can't call the New York Stock Exchange and say, I want to buy 500 shares of whatever company it is. You go through a stockbroker, and they're the ones that go to these markets and do that. Wall Street is just a street in New York City in the financial district where the New York Stock Exchange is and where a lot of the headquarters for your major banks and all your financial businesses mostly have offices on Wall Street. This is where I want to talk to you a little bit about liquidity in terms of risk versus return. Obviously, when we invest money, we want a return, or we want money coming back. Our whole entire goal for investing is to make money. And so there are different levels of risk. What I need for you to understand is the more risk that is involved, and these are things up here that are extremely risky, emerging markets. When I think of that, I think of the movie Forrest Gump, where he talks about investing in some fruit company called Apple. It was when Apple was getting started. It was emerging. It wasn't known to everyone. And so if you got in on the ground floor of Apple when no one knew much about it and it was just emerging, you became a very, very wealthy person. But you're gambling. Investing in the stock market is a gamble. You could make a lot of money, but you could lose every single thing you invest in. So, and when I talk about diversify, I have money personally in some growth stocks. I don't have all my money in growth stocks because I know that there's a potential for me to lose money, but I definitely have some money because there's a lot of potential for me to make more money. If I'm going to make money and more of it, this is probably the stocks that I'm going to have in. I also have some stocks in a more moderate risk, and these are your blue chip stocks, like I said. Well, we haven't talked about that, but we will. But blue chip stocks, these are your companies that like like Microsoft, like Walmart, like Coca-Cola, Johnson and Johnson, 3M. These are very large companies that are very stable. They're not going anywhere. If something bad happens to Walmart or Coca-Cola or Johnson and Johnson, things are really bad. Is there a potential for their prices to go down, their stock prices? Sure, but it's going to go back up. So it's a fairly safe investment. There is some risk, but not a lot. Low risk down here, your bond market, and we'll talk about the difference between a stock and a bond. Bonds are not as risky, but once again, you're not going to make as much money. And then down here at the very bottom, keeping money in cash. Obviously, if you keep it in cash, especially because of inflation, the value of that money is going to go down. If you put it in a savings account, you're not going to make very much money. So what I need for you to understand, the greater the risk, the greater potential there is for a return, but you could also lose it all. Down here at the very bottom, where there's very, very little risk or no risk at all, you might make a tiny bit of money, but you're not going to make very much.